Welcome to TMS Insights for the May edition. Jeremy Hook and Ben Clark bringing you some of the updates of things that have been happening in the market and the broader economy. And of course, May is the month of the budget, and that was probably one of the biggest talking points in terms of economics at the moment. Certainly a tighter budget and one that will have some implications, but Ben's certainly very pleased that nothing was mentioned and touched in the form of super.
No, so I think it would appear that most of our clients from a structural point of view have avoided sort of any pain, so to speak. The coalition, although has said that in their second term, if they were to be voted back in, that super changes are likely to be on the agenda. And you know, there are some things that potentially clients can look to do in the lead up to that to try and minimise any potential sort of tax pain if it were to occur. But for the moment, it all looks pretty good. I guess the only thing is, you know, we're seeing a big rein in government spending, pullback of government spending, and you know, we also will likely see sort of less spending out of the private sector as a result of some of these new taxes and cuts, etc. And that could see a bit of a softening in the economy. We expect. I think that's fair to say.
Yeah, and that's been really interesting. I mean, the macro impacts before the budget and with the budget obviously being tight, they've really impacted on bond yields, and that's something that's quite significant for our market overall. So, for all the talk, everything that's written, what's really happened is we've seen a very sharp decline in that bond yield, and that's got implications for our market and says quite a little bit about our growth outlook.
Yeah, I mean, at the start of the year in January, the 10-year bond yield was at 4.4%. So that's the market's expectations of what the average interest rate will be over the next 10 years. And that's fallen in 5 months to about 3.7%. And that's a very big move in such a long-dated interest rate. And that tells us several things. Firstly, that the market's expectation is that interest rates will stay lower for a much longer period of time than we were expecting, that economic growth might not be as strong as we were expecting, but it is good for some companies as well. You know, any company that prices their debt over longer term.
Well, analysts price every stock against some risk-free rate, like the 10-year bond. So when it falls and it's priced again, we could see valuations ratchet up and investors being prepared to pay more for stocks. So it's certainly very sensitive, the move on infrastructure stocks, REITs, banks, and most other companies in the market as well. So it's all other things being equal, for a share investor, a good thing and a good sign. That we've got those lower bond yields. Banks, we talked on banks.
Yes.
Now, April, May is the time when the banks give their half-yearly numbers. We got NAB, ANZ, Westpac. We got Bank of Queensland and Bendigo as well in this season. And we also got a quarterly from CommBank.
Yes.
Pretty good news.
And they were all good. You know, I think you'd have to say that the only sort of one that was a little bit more downbeat was NAB, which continues to sort of try and extricate itself from the UK. With a new CEO coming in, I think Cameron Klein was sort of deliberately cautious and wanted to hand the mantle over to him and not sort of lay out a strategy ahead. But it does look the cheapest of the banks, as per usual. So, you know, all the banks reported very similar themes, which was strong growing profits with you know, pick back up in credit. Although there was certainly signs that the credit environment's become more competitive. There seems to be some squeezing of margins as the banks offer better interest rates against each other. But ultimately, you know, I think we'd both agree the banks are in a great spot at the moment. The valuations, however, do look sort of fairly full, you'd have to say.
The prices have met the good results, haven't they? They've come up significantly.
And one thing to always be aware of is a lot of the growth in profits over the last few years, and including the last half, has still been from a reduction in their provisioning for future bad and doubtful debts. And there's only so much of that can be done on your bottom line. So it's just something to be a little bit careful of, I think, there.
Yeah, that's good.
But Jeremy, also when we did our last video update, a trade we did recommend that we spoke about was on the APA takeover bid for Investor, and we've had some further news, good news on the back of that.
Yeah, so Investor's major shareholder is Australian Pipeline, and Australian Pipeline had a script-based bid, which was travelling pretty slowly because there's a blocking stake in Investor held by CKI, which is an infrastructure investor out of Hong Kong. And at the very last minute, because the meeting was supposed to be this Wednesday, just passed. And 2 days before the meeting, CKO loved a cash bid of $1.32. And that was very well received by the market because cash is obviously very tangible. Scrip is quite debatable on valuation. So this hasn't run its course entirely yet. We haven't yet heard what Australian Pipeline might do in response, but it is possible they could launch a higher scrip bid. These things tend to go on a little bit longer than you think. It probably will move into the second half of the year, but certainly those who bought on that most recent comment from ours have done very well.
Yeah, it's been a great return in a market that's sort of treaded water since then.
Yeah.
I still think that one higher bid from APA is likely, and clients might take a longer term view in that APA has been a very well managed pipeline trust, and we'd be happy to end up with scrip in that ultimately.
Yeah.
Or there potentially is a shorter term trade if you're not looking to be a longer term holder of APA. So I guess we might have some concerns that the APA price will fall if they manage to secure control of Investor. But we'll be in touch as this all plays out, and I guess the main message is let's see what comes of it.
Yeah, basically good news.
Yep. And last thing today, we're getting toward the end of the financial year.
Yeah.
So I guess any sort of comments there, Jeremy?
Well, from Ben and I, obviously on the investment side, but within TMS Capital, we do obviously all the structural work and the related financial planning. And it is a time of year where we look at, from a superannuation perspective, the contributions that have gone in for the year to make sure that we're complying for our funds. And we'll be in touch on that, but also on the pension drawdown. So there's busy spreadsheets going on in the back rooms at TMS Capital, and we will be in touch over the course of May and into June to make sure that we're all compliant on those matters. So that's all we've got time for the May edition. We look forward to bringing you the next TMS Insights in June.